All right, let's talk about one of the biggest, oldest debates in the world of investing, growth versus value. Are you the kind of person who's chasing the next rocket ship to the moon? Or are you more of a treasure hunter, digging for that hidden gem no one else sees? These are the two fundamental schools of thought for picking stocks, and we're going to break them both down. Let's get right into it.
I just love this quote because it sets the stage perfectly. We're not talking about some dry, boring financial theory here. We're talking about two powerhouse approaches to building wealth. And just like the quote says, this isn't about choosing Batman or Superman. It's about understanding that sometimes you need the brilliant gadget-wielding strategist, and other times you need the raw, unstoppable force of nature.
So let's kick things off with our first hero, the growth stock. And that phrase on the screen, go big or go home, that pretty much sums up the entire philosophy. It is all about betting on a massive future.
So what exactly is a growth stock? Well, at its core, it's a company that's expected to grow way, way faster than the average company out there. The key word in all of this is expected. Investors aren't really paying for what the company is worth today. No, they're paying a premium for what they believe it's going to become tomorrow. It's a bet on rapid, continued, and sometimes explosive expansion.
What's really cool is how all these characteristics are totally interconnected. Because the whole game is about future potential, you're looking at these super innovative, often younger companies. This hype, this expectation, drives the stock price way up compared to what they're actually earning right now, which is why you get that high PE ratio. And this last point is absolutely crucial. They don't pay you dividends. Why? Because every single dollar they make gets plowed right back into the business. More research, more marketing, more expansion. They're feeding the beast to make it grow even faster.
Okay, let's shift gears and meet our second hero, the value stock. If growth investing is like spotting a rocket ship, value investing is, well, it's more like being a detective, hunting for those diamonds in the rough that everyone else has walked right past.
A value stock is, in the simplest terms, a stock that's on sale. It's a solid company that, for whatever reason, the market is down on. Its fundamentals, its sales, its earnings, they all suggest it should be worth more than its current price tag. A value investor's job is to spot this bargain, buy in, and then have the patience to wait for everyone else to catch on and for the price to correct itself.
So you can see here, value stocks are basically the mirror image of growth stocks. We're talking about stable, established companies, not flashy newcomers. Their PE ratios are low because you're getting a bargain on their earnings. And since they aren't in that hyper-growth, reinvest everything mode, they're much more likely to just reward you, the shareholder, directly with dividends. Now, you might be asking, why would a great company be on the bargain rack? Well, it could be anything. A bad news cycle, a temporary industry slump, something that spooked other investors but that a value hunter sees as a correctable problem.
Okay, we've met our two heroes. We know what makes them tick. Now it's time to put them side by side, in a direct head-to-head comparison, to really see the differences in black and white.
And this table just lays it all out so clearly. Look at the focus. Growth is all about tomorrow's potential. Value is about today's bargain. The company types couldn't be more different. The high-flying innovator versus the steady, stable giant. The PE ratio tells the story. High for growth means high expectations. Low for value means a potential deal. And finally, what do they do with the profits? Growth reinvests it for you. Value often just gives it to you as a dividend. Two completely different playbooks.
This is the million-dollar question, isn't it? The one with all the potential for huge gains must be the riskier one, right? Well, it's not quite that simple. Both of these styles have risk. It just shows up in very, very different ways.
And here they are, the two faces of risk. With growth stocks, you're on a high wire. The danger is that the incredible future everyone's betting on just doesn't materialize. And if that company stumbles and fails to deliver, that inflated stock price can come crashing down, hard and fast. For value stocks, the risk is more of a psychological one. It's the risk of being stuck in the waiting place. You might be totally right that the stock is a bargain, but there's no guarantee the market will ever agree with you. It could stay undervalued for years.
So we've defined them, we've compared them, we've even looked at the dark side of each. Where does that leave us? Let's get into this final section and figure out how to put it all together.
This is maybe one of the most important things to get. Neither style is the king forever. The market moves in cycles, kind of like seasons. For a decade, growth stocks might be the hot thing, soaking up all the sun. But then, the economy shifts, interest rates change, and suddenly those steady, reliable value stocks are what everyone wants. If you only pick one side, you risk being left out in the cold when the seasons change.
And that, of course, brings us to the real bottom line. This isn't about which style is better in a vacuum. It's about which approach, or maybe which blend of approaches, is right for you, for your goals, your timeline, and frankly, what helps you sleep at night.
This can help you figure out where you might lean. If you've got a long time to invest, say 5, 10, 20 years, and you can stomach some pretty big swings in the market, then growth might be your jam. You're playing for that big score down the road. But if you're closer to retirement, or you just prefer stability and want to protect what you've built while getting a nice steady income from dividends, well then you're probably going to feel more at home in the value camp.
And so we come full circle. The debate isn't really about choosing Batman or Superman. For most people, the smartest move is to build a team that has both. You combine the explosive potential of growth with the solid, steady foundation of value. That way, you're building a portfolio that's ready for anything the market throws at it. So the ultimate question isn't which one is better, it's how can you blend the best of both worlds to create your own resilient path to your financial future.
Don't forget to subscribe to the channel, like the video, and click on the bell icon to turn on notifications.